Why do pension funds and hedge funds prefer active investments? Since the beginning of international stock markets, investors have been trying to generate returns by investing in individual stocks, commodities, or in government bonds. And in most cases, this is an active asset management that uses the active form of financial investments. The active investment of money is the fundamental idea that one is able to achieve a higher profit than the average market earnings through active responses. A prerequisite, however, is that a certain competitive edge compared to overall market needs to be present. The investor must have this knowledge sooner or to a greater extent at their disposal than the market itself. The boundaries for the so-called insider trading, which is generally prohibited, are not very clear in this area. The general aim of active investment is to beat the market in the long term. This means that you want to achieve the highest possible profit, which is not only above the inflation rate, but also above the expected profit. So how do these funds attract customers? All actively managed collective investment funds attract customers by conveying them that they're capable of getting the best return on active investment. This is also the reason why individual stock, bond, or real estate investment funds like to advertise with the personality of the fund manager and his successes. When you look at the long-term success of active investments from a scientific standpoint, it quickly becomes clear that active fund managers' term of office is generally too short to be actually used to demonstrate a statistically proven long-term success. In reality, it's very common that an exceptionally successful fund manager invests mostly in a less successful real estate, bond, or equity fund in his next term of office. So if all these problems apply to all active investments as financial investments, then why are these investments so popular? One reason is that most people in the German-speaking countries still prefer to invest their money in a savings account. They've learned, however, that with this type of investment, you can expect little or no interest rates, and you might even end up losing money in the long run despite historically low inflation rates. Real estate, bond, or equity funds are the next step for financial investments with a high return and a manageable level of risk. Even with this, it must be generally assumed that the money is invested safely by a high level of diversification, and the yields are still higher than in a savings account or in an overnight deposit account. Another reason for the false perception of active investments is their representation in different media. Even the governments promote the acceptance of actively managed bonds, property, and equity funds through corresponding programs for private pension schemes. And then what happens is that it makes it possible for private investors to be advised by banks or financial advisors not to spend any money themselves. This system is becoming obsolete, so a few so-called honorary financial advisors can be found in German-speaking countries. This profession is remunerated by investors contrary to commission consultants, so that they get their money regardless of the eventual investment decision. This type of compensation increases the likelihood that they actually give the customer the best investment solution and not the product with the highest commission for themselves. If active investments have such low probability of success, then why only a few or none of hedge funds, bond funds, real estate, or equity funds follow passive investment strategy? Well, there are many reasons. First, it's the reputation of active investments. Because whenever you mention active investments to general public, they automatically assume that an active response always promises a higher profit than a passive one. Second, there is this assumption that a company grows only when it makes active decisions to expand and invest in its personnel, equipment, and material. We automatically generalize this perception on capital investments as well. The problem here is that Either the experience of investors is not enough to actually beat the market in the long run, or this generalization on investments is simply not true. The lack of hedge funds, bond funds, real estate, and equity funds with a passive investment profile is the fact that an investor who invests in a collective investment always hopes that someone else makes profitable decisions for her. A fund with a passive investment approach therefore means that entrusted capital is optimally managed, and that's always a problem. Active investments have a huge problem because they don't often achieve their own objective, which is to get higher returns than the market. Nevertheless, only collective investment schemes that pursue an active investment approach enjoy great popularity. It is generally assumed that most investors generate a lower return on investment than they need to reach average market earnings. Investments with a passive approach promise greater returns, but they are less popular and therefore less accepted. Thanks for watching. If you liked this educational video, please give it a thumbs up. If you'd like to learn about our passive investment strategy, you can visit the link with this video.